What kind of returns can we get with stocks, bonds, gold, and real estate if we apply our monthly asset allocation systems to these asset classes? This is Bill Scheid from Applied Finance Research, and in another video we looked at possible returns from just stocks, bonds, and gold, but what happens if we add real estate to the mix? That's the question we're going to take a look at in this video. So first of all, to begin with, let's take a look at the portfolio we're going to use to invest in our asset classes. So for gold, we're going to use the ETF GLD. For stocks, we're going to use the ETF SPY. We're going to use TLT for investing in bonds. And for real estate, we're going to use RWR. And this is the new element that we're adding for this video. The tool we're going to use to run our analyses is etfreplay.com, which is currently the standard tool that I use for all of our monthly asset allocation systems. This is a backtest. I generated this using etfreplay.com. It's the primary tool. Like I said, I backtest and run all of our systems using this tool. And here what we've done is run a backtest from the end of 2002 all the way through October of 2023. So this includes the financial crisis of 2008, the COVID crash of 2020, and everything in between. The graph on the left is an equity curve where the vertical axis is percent return and the horizontal axis is time. The green line is the back test of the system, and the blue line is the S&P 500. On the right, we see that our system returned 760.9% for this period, while the S&P returned 603%. Volatility is the annualized standard deviation of daily returns, and we see that the system had much lower volatility than the S&P 500. So in sum, the system has a greater return on lower volatility than the S&P. Here we see some summary statistics. The compounded annual growth rate for our system was 10.9% versus 9.8% for the S&P. Interestingly enough, the backtest, the system only has a correlation of 0.28 with the S&P 500, which if you're looking for diversification away from stocks, this is a pretty good number for measuring that particular dimension of the system, and not surprising since the S&P is only 1/4 of the portfolio. Here we see our maximum drawdown numbers. The system had a maximum drawdown of minus 24.5%, while the S&P had a maximum drawdown of minus 55.2%. Here we see that the system had a win rate of 62.4%, best period 14.34%, worst period minus 9.29, and period is our month, so best month, worst month. Median winning period 2.2, median losing period 1.5. And here we have a breakdown of the annual performance. For me personally, I like to look at how a system plays defense before I look at offense. Let's talk about the money we can avoid losing before we talk about the money making. So 2008, this is the year of the subprime mortgage crisis. Here we see that the S&P in this column lost minus 36.8%, whereas the system made 13.8%. The maximum drawdown for the S&P was minus 47.6%. That's a pretty rough year. Versus 24.5% for the system. So excellent job making money in the year of the subprime mortgage crisis on a drawdown of, what's that, roughly half, a little bit more than half of the S&P. I also like to look at 2020, the year of the COVID crash. S&P returned 18.4%. System barely beats it, 18.6%, but on much less drawdown. The S&P had a drawdown of 33.7%, only 13.3% for the system. So some excellent numbers on defense there. Also notice here on offense, we have a lot of years with double-digit returns. A good number of years where that first digit is a 2. And in all, we only have, 4 losing years. In the meantime, thank you very much for watching and happy investing.